We have Matthew Sullivan on the call. Matthew, really appreciate it. And he's with QuantmRE.com. And I'm going to make sure to put that in the show notes because it is spelled slightly different. It's QuantmRE.com. And I really appreciate your time. But today we're going to be talking about unlocking some of the equity in your home.
That's right.
So I really appreciate your time, Matthew.
Yeah, Jack, thank you for having me on. It's a pleasure to be on.
So this is a concept that I think, frankly, has been underserved on this show. And a lot of people struggle, especially when it comes to real estate investing, on how they can afford to buy that first rental property. But in your situation, I know that a lot of people actually use the term house rich, cash poor. And can you talk about that term and how they can maybe make use of some equity they might have in their house?
Thank you. Well, the equity or home equity is a funny thing. It's wrapped in all sorts of psychological and legacy attachments. In other words, many people are brought up so that whatever you do, don't touch the equity in your home. Don't just use anything other than that. Sell your dog for scientific experiments, but do not under any circumstances touch your equity. But the biggest issue is that for most people, the bulk of their wealth is in their home equity. And I think some of the numbers are astonishing. There's over $16 trillion of home equity in residential homes in the United States. And there are more than 15 million homes where the homeowners have more than 50% equity. So for all of those people, home equity represents probably the bulk of your wealth. And here's the issue. If you want to unlock that, or get your hands on it so you can actually do something with it, the only way you can do that is to go back to the bank and to get deeper into debt. And you do that by a cash out refinance, a second mortgage, a home equity line of credit. If you qualify, you might consider a reverse mortgage. Those are all different flavors of debt. And ultimately what that means is that you've got, in most cases, monthly payments that you didn't have before. You've got this sort of looming specter. If you miss a payment, then the bank can come in and take your home away from you. So that's why I think most people are quite frightened. Well, not frightened, but they're just averse to going back into debt. But a home equity agreement is a very different animal altogether. We are investors, not lenders. Now, what that means is, in exchange for a lump sum that we invest in your property, we get the right to share in some of the appreciation when you sell the home. So the trade, if you said earlier, as you said earlier, you've got house rich and cash poor on one side. The other side of the equation is, how about I got loads of cash and I want to get invested in residential homes? So the investors want to find a way of investing in homes that are not for sale. And for them, it's a great investment opportunity because they can participate as partners with the homeowner. They don't have to own the home, which means they don't have to deal with all of the cost and all of those sort of friction points of having to actually deal with a home, with all the the maintenance and the dealing with renters. So we co-invest with a homeowner. But the great thing is we don't go on title. We're not a co-owner. We just share in some of the appreciation. Now, what that means for a homeowner, to answer your point, is that we can unlock up to $500,000 from your home equity. That's if you've got enough equity there to start with. There are no monthly payments for up to 30 years because it's not a loan. So why would we charge monthly payments? There's no interest. Doesn't appear as debt on your credit report because it isn't debt. And you've got access to that, and there's no immediate tax implications. So it's not income, it's not capital gains. All of that is deferred until you actually sell your home and you settle up with the tax man then. So for people that have homes where they've built up substantial amounts of equity, but they don't want to go back and borrow it, or maybe they can't because it's outside of their, if they've only got a certain amount of rental income, then maybe the bank just won't lend you money. But this is a great way of tapping into that equity without the burden of monthly payments, which you can then use to expand your portfolio or to invest in some other product or some other asset class that generates cash flow, or just gives you the ability to diversify out of what is essentially a large, concentrated, non-financial asset.
Yeah. So, on its surface, this, I hate to be this blunt, but it sounds too good to be true. I mean, what is...
You're not the first person to say that.
Yeah. But so how does QuantmRE make money at this? I know
well, we're investors. I'll tell you exactly. It's a question, and I'm so pleased you asked that, because that is the immediate response that people get, because they hear no monthly payments and they equate that to free money.
Right.
Well, it's not, because we make our return when you sell your home. If your home has gone up in value, then some of the amount of that appreciation goes to us, in addition to the return of our original investment.
Sure.
So in other words, let's say you had a $100,000 home, for the sake of round numbers, and we invested in 10% of the equity. So we gave you $10,000. That's our investment. And let's say you stayed in the home for a few years and your home went up to $110,000 in value. So it's appreciated by $10,000. So if you sold the home at that point, or you decided you wanted to buy back the agreement, you would give us back our $10,000. That's our original investment. And then we would say we want 30%, because we don't just take 10%, we take a slightly magnified share. We also want 30% of the appreciation. So 30% of 10,000 is 3,000. So our original investment was 10. We get back 13. So that's a good return for us. It's been great for you, though, because you've had use of that $10,000 with no monthly payments. And because it's not a loan, so there is no interest, there are no monthly payments, because we get our payment at the back end when you sell your home. You can do something with that $10,000 that makes you much more than $13,000. So the idea is that you use that money to invest in something that gives you a much better return than what it's ultimately going to cost you.
Sure. So how do you decide whether somebody is a good fit for your program?
We look at the property primarily. So unlike a lender that looks at the person and says, do you have the ability to borrow more money? Do you have the income or the credit score? First of all, we look at the property. Do you have enough equity in the property? So in order to qualify, you need to have around 60%, maximum 60% loan to value, which means you've got about 40% equity. So that's where you need to start. And then we can think about unlocking. In most cases, we unlock no more than 20% of the value of your home. In some cases, in California, for example, we can go up to sort of mid to late 30s, maybe even 40%. But we're looking primarily at the property, how much equity there is, and where is the property. If you're in a rural area, we're probably going to say no. If you're in a main, metropolitan service area, where it's relatively easy to price your home, we're likely to say yes. We don't operate in every state, so we and our partners, we operate across 19 states at the moment. But really, as I said, to answer your question, we're looking primarily at how much equity there is in the home, and then we're going to start asking questions about you. I mean, give us an idea about your income. What is your credit score? Because if your credit score is really low, that's kind of below 500, then that's an indication that we might have some problems further down the road where you may not be able to continue to pay your mortgage, and that's going to have an impact on us. So we do take credit scores into account, but at a very low level. And again, income and all of those characteristics will take into account just to make sure that we can build confidence that you're likely to be able to continue to meet your obligations as a homeowner.
Sure. This is a relatively newer concept for me. So how long has this been a thing? Like,
yeah, it's around 10 years. So the original, and again, this is different to a tenancy in common. So the most important difference is this is not co-ownership. Now, co-ownership has been around for millennia, but this is an option agreement that does not transfer any ownership to the homeowner, but does give some rights to the investor to share in the economic returns of the property. Now, that's very important because there's no ownership change, and that means that there's no revaluation of the taxation situation in terms of property taxes. It doesn't trigger any due on sale clauses for the mortgage. But it's this type of agreement, this type of option agreement has been around for about 10 years. It was originated by a company called Equity Key in San Diego. And really over the last 3 to 4 years, more and more companies are, and there's about half a dozen of us at the moment who are offering these types of agreements. I think we're going to see a huge increase in adoption of this type of way of unlocking capital. And I would predict that in, probably 5 to 10 years, it will become a mainstream product. So as a homeowner, you'll be able to go to the bank and they will offer you loans as well as these types of equity participation agreements.
Sure. Just to remind everybody, we're talking to Matthew Sullivan. He's with QuantmRE. If you go to the YouTube channel, you can see how it's spelled. It's QuantmRE.com for some more information. But let's flip the side here a little bit. Do you also offer, you're already talking to homeowners who are trying to unlock equity, but do you talk to people that want to participate in what you're doing as well, like as
yes
investors?
And again, what you've managed to do is hit the nail on the head. 2 out of 2 now. So yes. Yeah. So the other side of the equation is, okay, so it's a $15 trillion market that no one's investing in at the moment. It's a huge untapped real estate asset. So yes, we are absolutely determined to make this type of investment opportunity available to smaller investors. And that's been our plan. We've been around for 3 years. We've been focused over the last 18 months to 2 years on originating transactions. So that's getting homeowners to understand how this is a great option for them to unlock their capital. What we now want to do is open this type of investment up to smaller investors. So our platform has been designed to make home equity accessible, investable, and tradable. Now, tradable is a very critical part of this equation as well. So as an investor, our platform will enable you to go on and you'll be able to see a map of all of the potential investments you can make, all of the home equity agreements that we own, where you can buy some or all of that agreement. So we are using blockchain technologies to fractionalize these individual home equity agreements that are real estate assets with a return profile secured by real estate. So our platform will fractionalize these. So as a smaller investor, our plan, we're pretty confident we'll be able to get this done by the end of the year. You'll be able to go on and choose your own portfolio of properties. So if you've always wanted to build a portfolio of properties in Newport Beach, California, and Sacramento or something like that, you'll be able to invest a couple of $1,000s by putting a few $100s into this property here and a few $100 into that property there. And then every month we revalue those investments based on how the underlying home has performed. And most importantly, our plan is to enable you to sell those fractions whenever you want as well. So once the underlying asset has increased, and once the value of your fractionalized investment has gone up, our platform will enable you in a very compliant from a regulatory perspective, because this is a security that we're talking about here, you'll be able to sell those into the marketplace and get some cash out that you can then use for something or reinvest into another property.
So is it your platform already allow this?
It does. It allows you to buy from a homeowner. You're able to give us your details, calculate the amount of equity. So the homeowner side is working. We are still building the trading side of it. We've been building it for 3 years now, and really just waiting for the rest of the world to catch up. And I don't mean that in a in a silly sort of way, but waiting for blockchain technologies and the regulatory environment, and really people's understanding about what these things are. 3 years ago, people would say, well, where's the cash pay and where's the liquidity? And do I have to wait 30 years for someone to sell their home before I get my money back? So we're just waiting. We have been waiting for this to become more widespread. And I think that point is happening now. But it's not live yet, but it will be live in stages over the next 3 to 6 months. So, we're busy working hard behind the scenes, making all of that happen.
So yeah, so I have to give you credit. You're the first person. I've done this show for a few years here now, and you're the first person who has brought up blockchain on the show.
Yes. Is that a good thing or a bad thing?
Well, no, I'm just, it's a sign of the times, one of those things. I'm a bit of a nerd when it comes to some of this stuff. And it's very telling, because unfortunately, a lot of the real estate industry is behind the curve on a lot of this technology.
Yes. I mean, what we're using the technology for is, you see, blockchain is a very efficient way of keeping track of transactions. It is a distributed ledger technology. And I know it sounds, obvious to say that. If you try and use it for the wrong thing, you are putting your square peg into the round hole. But using blockchain to keep track of all of these, atoms of people's properties and these home equity agreements is an ideal use case. Now, we are partnered with a company called Algorand, which is very much at the forefront of blockchain technology that's been designed for securities and for DeFi. Now, DeFi is this whole, sort of distributed finance or, decentralized finance. So, our view, along with everyone else's view in this, in the blockchain world, is that there will be a number of platforms which will effectively floating in space, as it were, where you can buy and sell really interesting things like, fractions of people's homes, or securities, where you could buy maybe $10 worth of Amazon stock or something like that. All of that will be powered by these super light, thin technologies that are robust and reliable and trustworthy, which is really the promise that blockchain gives us. Sure.
So you were talking about how this isn't technically like what we would typically see as a home equity loan. It's not a second mortgage. It's not. How is the investor protected in that aspect then?
Well, he's protected, or she, is protected by a lien. So the investor, we record a lien on property, on the property. So the agreement itself, which is characterized in language that's very similar to a trust deed, but obviously it's not a loan, but it has similar characteristics. So, there is a certain amount that was initially invested. When the property goes through the sales process, the contract will reference the amount that needs to be repaid, both out of the original investment plus the way that the share of the increase in value is calculated. So all of that is really put into the trust document, which we refer to as a performance deed of trust, and that is secured by a lien on the property.
Sure. Okay. So with all of that, I know that this is a really loaded question, and you're probably going to end up having to give me a pretty wide range. But what would somebody expect as a return?
Well, I think the returns typically that we are getting and this is based on audited information through one of the funds that we work with, is double digits to sort of low teen returns. So that is the sort of return that we are targeting. It's an equity return, and that's based on effectively like a leveraged return based on the underlying house price index. So if the house price index goes up by, say, 4%, then the investors should be able to get about a 3 times return of that, because the way the agreements work is you get a multiple of the amount that you invest as a share of the appreciation. So what I mean by that is, if I buy into 10% of your home equity, I don't just get 10% of the appreciation. I get 30% of the appreciation, which is effectively a 3x return on the underlying house price index. So we are realistically discussing targeted returns of low teens, and as I said, that's based on audited figures. And obviously, historical performance is not an indication of future performance, but we know that residential real estate historically does outperform inflation, and so it's the returns should be attractive to investors.
And you've been doing this a while now. You said the homeowner can be in their house for 30 years and they wouldn't have to buy out your contract until then. But how soon do you typically see that those homeowners cashing out or selling?
Well, we're beginning to see the modeling that we've done, and the evidence that we're seeing shows that people that take out these agreements don't stay in their homes any longer than a normal sort of homeowner profile would be. So what that means is people are still moving on average, every 7 years. People that take out these agreements, funnily enough, we're seeing in some cases they settle them earlier, because what we do is we enable them to get back on their feet financially. So because it's not a loan, they can use it to restore their credit score. And if they can get their credit score up into the 700s, which is entirely possible to do, then suddenly they're able to get the sort of HELOCs or the loans that they couldn't get. So some people actually buy us out with loans, because that's their choice. But we're not seeing just because you take out a 30-year agreement, we're not seeing people. The evidence is that they're not. It doesn't look like they're going to be staying in there for any longer. In the same way, if you take out a 30-year mortgage, you don't have to stay in your home for 30 years.
Right. So is there with that, I just want to remind everybody, head over to QuantmRE.com. I know that you're pretty active on all the social media as well, but this is Matthew Sullivan, and Matt also has. I never asked you if Matt is okay, or is it Matthew?
It's fine. Yes, please. What do they say? You can call me whatever you like, just don't call me late for dinner. Yes, absolutely. Yes.
But you also have a podcast, Hooked on Startups. I really want to send everybody there too to check that out.
It's very kind. Thank you. Yeah, I started that 4 years ago, I think, and I did 59 episodes. And then I thought, I'm just going to put it on hold for like a couple of weeks, because that's when I launched QuantmRE and we started building that. So 3 years later, the interregnum, the period of hiatus extended rather than being a month, and it ended up being 3 years. But season 2 of Hooked on Startups, I did my first recording yesterday. So watch out, world. I'm back. So I think we've got 4 listeners so far. So if we get 8, we can have 100% increase in our audience.
So, well, 4 of you go over and check that out. Subscribe to his show. I'm gonna end. I usually end the show a different way here, but I'm gonna ask you something completely different. Since you're a founder of a company, you're 3 years into this right now. And the expression on your face already tells me, well, what is he going to ask me here now?
Yes, you can. Yes.
Give me some lessons you've learned. I think one of those things that as real estate investors, a lot of people get into real estate investing. It's a side hustle. They've been sold this concept of get rich quick. I think one of the big lessons is that they have to treat it like a business.
Yes.
What are those 3 lessons, if you have 3 lessons that you've learned in your journey towards building this platform?
I completely agree with you. And I always say that any type of investing where you're an active investor, even if you're a passive investor, do your research. If you're an active investor, you're absolutely right. Treat it like a job. Now, the path for quantum has not been easy, because we're trying to do something new. And as you said, the first question you asked was, this is too good to be true. So we have all of these different friction points or sort of challenges that we have to overcome.
Mm-hmm.
So the easiest thing to do is say, well, I'm just going to, the first time I hit a bump in the road, you go, well, it's just too hard. It doesn't work out. So you've got to have a rather large degree of grit or determination or just the ability to stick at something. Now, I love this business. Every day, it's I don't want to use the word passion because it's just so overused, but I love it. I love, what we're doing, because I think it's really important to be able to offer an alternative to homeowners who are stuck, because I remember so many occasions where I had no money, but I had tons of cash and no one would lend me anything because all my money was locked up in this house. So for me, it's a bit of a, I want to make that happen. But also I love the innovation, both from a legal perspective, from a securities, from a technology perspective. So I'm creating something. So despite that, it would have been so easy to give up. So, success is 99% perspiration, 1% inspiration. So it's the ability to stick at something. And if you've got a vision, don't let other people dissuade you. Be coachable, listen to them, but don't, this is your idea. And in most cases, people haven't had your idea and they don't have the same passion that you do. And so you are probably the only person that can make this work. So all these other people that are giving you advice, you can be grateful for their advice, but stick to your guns, because you will make it work. And the other thing is that if you do believe in something, and you work at it hard enough, and those two are very important, brothers in the pathway to success, then there is an inevitability about what you do, and it will happen. So in other words, if you stick at something and drive it with enough energy, then it has this inevitableness. I've just created a word. It has an inevitability. Please, for God's sake, take that out in the edits. But it will. It has this inevitability. So those are the things that I've learned, and it's, everyone knows that it's not a miraculous sort of road to Damascus speech. It's just common sense, really. But it's you learn the hard way. So you've got to be old and ugly to be able to sort of learn this, and hopefully you can pass that on. One can pass it on to people so they don't have to go through the same pain.
No, that's some great lessons there. I really appreciate your time here. And was there anything that you wish we would have covered here today that I forgot to ask or missed to ask?
No, I think you did you asked some fabulous questions, and there's obviously lots to what we do. There are, in the agreement, as you would expect, there are terms and conditions. There's nothing hidden. There are no out-of-pocket expenses. We don't ask you to stump up the cash for the appraisal. We'll do that, but we will take it out of the money that we invest. So don't worry, we'll make sure that we get paid back. But no, there's nothing there. But give us a call, find out more. We've got a free guide that we can send you. It's not for everyone. Many people, we've helped hundreds of homeowners, but it's not for everyone. But just contact us and we'd love to tell you more about it.
Yeah, I'll make sure all of those links are in the show notes. Really appreciate your time. It was great to chat with you here today.
Thank you, and thank you for having me on. It was my absolute pleasure.